Hi everyone, I will be explaining what a small and medium enterprise or SME actually is. Simply to put, an SME is a company where the sales turnover or the number of employees falls below a certain limit that has been set by the government. SME are incredibly important to us. In fact, they are the backbone of the Malaysian economy, making up to 97.4% of all businesses establishments in this country are from SME. So, there are two main sectors in SME, manufacturing and sales and services. For this slide, I will be focused on both manufacturing and sales and services criteria shown here. For manufacturing sector, a company is considered small if it has sales between 300,000 ringgit to 15 million ringgit or has 5 to 75 employees. A company is considered medium if it has sales up to 50 million ringgit or has employees up to 200 employees. For sales and services, a company is considered small if it has sales between 300,000 and 3 million ringgit or has 5 to 30 employees. A company is considered medium if it has sales up to 50 million ringgit or has up to 75 employees.
Okay, so now I will explain some of the key issues related to small and medium enterprise. First, lag behind in digital adoption. Although many digital tools and financial softwares are available, not all SMEs are able to adopt them effectively. This is because some businesses lack digital skills, face talent shortage, or unsure how to use new technologies. As a result, their digital progress is slow and uneven. Second one is pressure and rising in ESG compliant costs. Many SMEs are under pressure to comply with environmental, social, and governance requirements. With the upcoming e-invoicing mandate, small businesses are concerned about their readiness, the cost of upgrading system, and ensuring compliance can be high, especially for smaller firms with limited resources. Next, expanded e-invoicing exception. To help SMEs, government has provided an expanded e-invoicing exception. This allows affected small businesses an additional year to prepare for full e-invoice compliance. During this period, they will not face penalty from the Inland Revenue Board or LHDN. This exemption gives SMEs more time to adjust and reduce financial strain.
The fourth issue related to small and medium businesses is regulatory and compliance burden. In addition to the rising in ESG compliance costs and e-invoicing exemption, there are also regulations that needs to be obeyed and followed. These additional mandates contribute to the rising costs, complexities, and specialized expertise that small and medium businesses find difficult to afford. Next, limited access to financing. Many small and medium businesses lack strong financial records, limiting their funding options for expansion, technology upgrades, and working capital management. The demand for market-based and government-supported loans remains high, but awareness and access are still insufficient across the sector. Last but not least, labor shortages and talent retention. According to an article that we examined, It is stated that 52% of small and medium businesses identify salary and talent retention as a core issue in their businesses. This is because of the increased minimum wage requirement by the government. Thus, rise the challenge of attracting skilled workers away from larger firms offering better remuneration.
For the calculation of the 3-relevant cash flow, we start with the initial outlay first. We calculate the cost of machine first, which is 1,337,550 ringgit, and then we add the working capital and get the value of 1,350,550 ringgit. After that, we minus the cash inflow that include the sales proceeds of old machine and tax gain. But before that, you must be wondering how to get the value of the tax gain right. So let me explain. Firstly, we must find the depreciable amount, which is the purchase price minus with the salvage value. Secondly, we find the depreciation per year, which is the depreciable amount divided with the useful life. Thirdly, we find the accumulated depreciation by multiplying the depreciation per year with the past useful life. Fourth, we find the net book value by minus the accumulated depreciation with purchase price. Fifth, we find the loss on disposal of old machine by sales proceeds minus with the net book value. And lastly, we will find the tax gain by loss on disposal of old machine multiplied with the tax rate of 26% that can be found in the question, and we got a value of 26,000 ringgit. Thus, the value of initial outlay will be 976,550 ringgit. Alright, so now we find the annual differential cash flow. So before we start, basically the annual differential cash flow are just finding the difference between using the old machine and new machine, whether it's increasing or decreasing, and all of the value can be obtained from the question. So first, we find the benefits when we obtain the new machine, and we got a value of 640,000 ringgit, and then minus with the cost of 435,943 ringgit and 75 cents, and then we get an increasing profit of 204,056 ringgit point 25 cents. Then we minus the tax as we can see here, and the tax rate can be obtained in the question, and we get the value of profit after tax of 151,001 ringgit point 62 cents. Lastly, we add back the depreciation and we got the after-tax differential cash flow of 256,945 ringgit point 37 cents. And now we're moving on to the terminal cash flow. So firstly, we took the salvage value of new machine of 90,000 ringgit, and then we add the inventories of 15,000 ringgit, and then we will get the value of the terminal cash flow of 105,000 ringgit.
This is a simple overview table that shows two methods that have been used for making a financial decision for a new acquisition of machine. The first method that have been used is net present value, and the second method is payback period. For the first method, the result we get is a positive number, which is 99,100.44 cents. The positive number indicates a project generates a return higher than the 80% cost of capital. For the second method, which is the payback period, the result that we get is 3.8 years, which is below than the allowable year of the company. It's indicate the action of the acquisition of new machine is remain acceptable because the payback period is 3.8 years, which is below than the allowable of the company year, which is 5 years. Let's break down the two main decision making techniques that support these financial decisions or the choices of these two methods. Firstly, we look at the payback period method. The project will recover its initial outlay in 3.8 years, which is below than 5 years. This is well because it within the company maximum allowable year, which is 5 years. The positive impact ensures that the company funds are recovered quickly, maintaining the capital availability for other users. Moving forward, a company should adopt a strict policy to reject any project that exceeding this 5 years limit to protect the company's liquidity. Secondly, we analyze the profitability using net present value. The project show a positive NPV, which is 99,100.44 cents. A positive NPV indicates this project generates a return significantly higher than our required 18% cost of capital. As a recommendation, we advise prioritizing projects with positive NPV for long-term investments to ensure sustainable financial expansions. To wrap up our presentation, the investment appraisal confirms that acquiring the new machines is financially sound strategic decisions for our company, which is ZX Garments. The decision successfully satisfies both our critical criteria, which is liquidity and profitability. By achieving a positive NPV of over 99,100.44 cents and securing a payback period of just 3.8 years, which is below than 5 years, this project promised to maximize shareholder wealth while minimizing our long-term risk. This exercise was not just about buying a machine; it was about overcoming common SME challenge. By using this data-driven approach, we address issues like limited financing by ensuring a capital is only allocated to project with proven calculated returns. I would like to leave you with this thought. Proceeding with these acquisitions demonstrate that with good planning and the right steps, you can create a brighter and more stable financial future. That's all from us. Thank you.